Welcome to the Executive Real Estate Investing Show. This podcast is for you, the busy business owner or executive looking to create generational wealth. Here, we're going to show you how to do that through real estate investing, from multifamily to industrial and everything in between. You will become a real estate investing expert. And now, here's your host, Michael Holman.
Hello, everyone, and welcome to another episode of the Executive Real Estate Investing Show. I'm your host, Michael Holman. We have an awesome show today. Jonathan Livi, he is an equity broker, and he's in the real estate space like crazy, and he is wicked smart. He knows everything that's going on. I mean, if there's somebody out there, he probably knows who it is, and he's dealing in probably the most difficult part of the entire capital stack, the equity. So definitely want to tune into today's episode. Before we get into today's executive tip, go check out the website, executivereishow.com. We got episodes, we got videos, we got resources. You can ask a question, leave a rating and review, all of that stuff. Go out, check it out, executivereishow.com. Love to hear from you there. Also, if you're liking what you're hearing, please leave us a rating and review. Apple Podcast, Spotify, Stitcher, wherever you're listening to this podcast. We love to get the word out. The more we can get the word out, the more people we can help. The more business owners, the more business executives, the more aspiring business owners we can help reach and teach about this wonderful, wonderful investing tool called real estate investing, so that they can go from a knowledge to an expert. And that is our goal. So leave us a rating and review. Getting into today's executive tip, and I might have said this before, but I'm going to say it again. Be creative, right? Don't get stuck in a box. And that's what you're going to find too, especially as we go throughout this episode today. I mean, in the equity space, you can pretty much do anything. I mean, there's an infinite number of possibilities, of combinations, of subsets. I mean, it's not black and white by any means. And that's how most industries are. I mean, no matter what you're an expert in, no matter what you're trying to grow your business in, there's room for creativity. 100% guaranteed, no questions asked. It might be really easy to be creative, and it might be really difficult to be creative, but there's options to be creative. We deal with this all the time. I mean, as real estate developers, even, we have to be really creative in how we get all the money. I mean, that's just one example. I mean, there's an infinite number of possibilities. Don't get stuck in the box, right? And you're only going to find those creative solutions if you make the determination before the situation happens that you're going to be creative, that you're going to start reaching out, that you're going to start making those networks and those decisions that can take you from being just in the box, which potentially kills some deals, kills some opportunities, to getting outside the box. Right? So don't be afraid, get outside the box and be creative. Now let's get into this episode with Jonathan Livi. Hello, everyone, and welcome to another episode of the Executive Real Estate Investing Show. As always, I'm your host, Michael Holman, and we have a great guest with us today. His name's Jonathan Livi. He is out of New York, and he is doing all sorts of real estate, everything. He's been a mortgage broker. He's into equity. He's building a business, a lot of great information. I've actually been working with Jonathan on a number of deals that we do personally, and that has been a great experience, and is what led to his invitation on this podcast. Just a quick introduction to him. So he's an equity broker. He likes to claim that he's asset class agnostic, meaning he is good with just about everything that you can throw at him, really flexible. And then a couple of just personal things that we were actually just talking about, Jonathan. You teach Bible classes or Torah classes as a major passion, and you have a podcast called the Parasha Podcast. So fun stuff. Jonathan, welcome to the show.
Thank you so much, Michael. Appreciate the invite.
Absolutely. Well, Jonathan, tell the listeners a little bit about yourself.
Sure. Been in real estate now for 4+ years or something. I did it right after I did some extra schooling for Jewish studies. So right after college, I stayed for an extra year and did some Jewish studies. I went to Yeshiva University, which is like a combined Jewish, educational school with a secular college. So we combined those studies. It's full days. But I did that for 3 years of undergrad, and then I stayed an extra year to do some extra Jewish studies. After which I jumped into real estate. As everybody who jumps into real estate got beaten up a little bit in the first couple of years. But I learned quick. I have a degree in economics, and I've always been fascinated by finance. So it didn't take long to just understand how a capital stack works and how it's supposed to be structured. Getting into the mortgage brokerage business, it was great. I was traveling a lot, was meeting a lot of people. But my frustration with it was that it was a bit commoditized. So, you're dealing with something that pretty much anybody else could put together. It's more of like you'll stand out by how much you hustle kind of business, because you're all, dealing with the same commodity. So I started to I had expertise in finance, and I could understand the way capital stack was structured, understand joint ventures, understood waterfalls, all the fun stuff that a lot of people find is a little bit arcane. And then I was like, you know what? If I have that skill set, might as well put it to use. So I jumped into the equity brokerage business, got all my securities licenses and things like that are required. People don't know about that, by the way, that you need a securities license in order to do this. But and been off just making introductions on the equity side. It's a fun combination of network. It's constant networking with developers and building relationships with developers who are doing cool projects and who need large amounts of capital. And then it's constant networking on the capital side to see if you could, find interesting sources of capital for those same developers. So it's a constant growth of the business on both sides. What I tell developers is like, you build a relationship with us and we know what you're doing. It's beneficial to you because, I'll give you an example. We have a developer that I've been speaking to, very, very large developer. And, they're buying core plus assets. The typical stuff right now is quite overpriced. So they're hitting IRRs of like 11% on this core plus, stuff with like a 6 to 7% cash on cash. They're buying it at like a 3.5 cap typically. So they're looking for cheap capital, right? And the stuff that, the typical groups will reach out to the institutional groups in the US that are looking for that 11 to 13% IRR on the core plus asset. Those groups, their capital is a bit too expensive because the market just doesn't allow for that, those kinds of IRRs anymore. So for a group like that, I've been doing some research into overseas capital, so it's constantly just find a client, see what they need, and then go back and start networking more on the capital side. And as those relationships grow and the potential only grows more, you learn exactly where capital wants to go. At the same time, you learn exactly what clients are looking for. You get a very good bird's eye view of the entire market. Again, as you said, we're asset class agnostic. So we're doing deals in industrial, we're doing in multifamily, we're doing self-storage. Retail, even we've done a couple of CoGPs on retail deals. We're doing a medical office CoGP right now.
Awesome.
So we're all over the place. We underwrite everything, and it's just a lot of relationships to maintain. So it's a lot of phone calls and a lot of getting the word out and meeting people in person when possible.
Yeah, that's awesome. And I love how you kind of mentioned, because I've seen the same thing, right? You're talking about how oftentimes, especially in today's market, it's being a mortgage broker oftentimes feels like a commodity, right? And to some extent, I honestly, I completely agree. A lot of times it's related not to what the loan is at the end of the day, because a lot of times people see the same lenders, people are going to the same lenders. It's who's the person that's playing point on that, right? It's kind of like what you said, it's how much hustle they have. And so you made this switch. I'm assuming you made the switch to equity because it felt like a lot higher barrier to entry. Would that be correct?
That's true. And there's another element. It's my original interest in real estate was because I wanted to be an investor. I wanted to, I had dreams of, as you can see, I have a lot of passions outside of work.
Yep.
So, there was a dream of being able to develop some streams of income other than my day-to-day job and develop some freedom. At the end of the day, I think our biggest commodity as humans is time, and real estate, if you do it right, can be a great way of buying yourself some time. So on the underwriting on the debt side, is more, it's very downside underwriting. Lenders only underwrite to the downside. So they don't really care about your IRR. They just care about what the downside is on the deal. If you're sporting them at 30% IRR and you put them in for 90% leverage, they're not going to do the deal because that's a lot of leverage. So there's plenty of upside in that deal, but because they're not getting it, the lender never gets the upside. So they're only underwriting for the downside. So to really learn how to underwrite, it was going to take more than just being a mortgage broker and being on the equity side. I mean, I don't want to encourage other people to get into the space because I'm not looking for new competitors, but but at the end of the day, it's a different style of underwriting. You're more analyzing to see if, the first thing is you have to like the deal yourself. So to know if you like the deal yourself, you have to learn how to actually understand the fundamentals. And that's what I gained most, especially at my time at Buckingham, with the help of Simon Goldstein, who's the principal here. There was a lot of learning how to underwrite and, to quickly understand, to see what's going on, what all these numbers mean, not just an LTV, but, is that a true IRR? What kind of assumptions are going into creating that IRR? How does, and they're generating these IRR. What are their growth assumptions? What are they paying per unit? What's their basis in the property? So that's how I ended up developing the confidence to also do CoGP investments and syndicating capital from people that we know, from friends and family. Just to give you a little bit of insight into that, when we broker an equity deal, it's just a plain institutional equity group with an institutional grade sponsor. But we're typically doing CoGPs with smaller sponsors. We're buying much smaller deals that are the kinds of deals that are beneath the radar of the institutions. And for those, we rely on our own underwriting skills to actually make sure, we're buying right. So to get to that level, it took, I wouldn't have been able to get to that point if I was doing just mortgage brokerage. It's just the underwriting is completely different. So that was the motivation. I wanted to, become a better underwriter and gain more confidence on the investment side. And of course, if you have the knowledge to structure a waterfall, you get paid for knowledge in this business. So, like the fees are larger. You have much more negotiating power to maintain your fees. And as you get better and older and you have more deals under your belt, you can be more and more demanding on your pay. So
yeah, no, that's awesome. And the thing that I love about you is you are a great networker. I mean, I know that we've seen each other through LinkedIn. I think that might have been how we actually hooked up. It feels like I'm saying that every single week, to be honest, with every single one of the guests. But I remember I've seen everything where you've even outlined general waterfall structures and, hey, here's what a JV structure looks like. Just awesome knowledge that you're just sharing with everybody. And I assume that that's part of this networking that you're talking about. I mean, what are your favorite ways to connect with people? I mean, because you have to go out and you have to find these developers who are trying to get the capital. How are you networking with them?
So I'll tell you, the first thing is LinkedIn is huge. I mean, it used to be that your company used to provide you a list of people, and like they would have to generate that list. It probably cost them some money to generate the list. It's on Excel. You have an email and you have a phone number and you just call. Mm-hmm. First of all, in the equity business, you're not fishing for people who've been overlooked. In the equity business, you're trying to build relationships with like the top developers. You know what I mean? Because you're gonna, the sword that you die on is going to be the quality of the sponsors that you know.
Yep.
If you know sponsors that just aren't up to par, and there are plenty of them that are coming to look for equity, because who else would look for equity other than the people that don't have their act together? Yep. If those are the only guys you're working with, then you're going to develop a really bad name, and none of the institutional investors are going to want to talk to you. So that whole system of just taking a list and cold calling, I would not say is the perfect fit for like the equity brokerage business. What LinkedIn does is, there are great search tools for contacts. So if you have a big enough contact list, I mean, I don't know how it just happens. I don't friend request people so often on LinkedIn, but I have thousands of people that are in my network. Yep. That's larger than any list that could have been provided to me by the heads of my company.
Yep.
And you can direct message them all. The strategy with LinkedIn, I'm very serious about trying to be very, very, very light on the fluff. I'm not a fluffy guy. I don't like to waste time, and I like to shoot people straight. So the goal is to always provide value. I mean, from the second you speak to a client, your goal should be to be a source of value for them. First deals, frankly, barely ever work out with a client.
Yep.
So you gotta try a couple of times.
Yep.
But in that first deal, you could prove that you actually provide value. You'll make introductions that could be productive down the line. So the same things with LinkedIn. I mean, I got my start with a very good buddy of mine, Aaron Zucker, who's in the retail world. He buys
Yep.
retail deals that have a quick value add component. He's an expert in leasing retail. So he comes at it from a leasing broker's perspective. And he just showed me the ropes on LinkedIn, and I quickly just made it my goal to just, provide as much knowledge as possible to the public about what we do and, how a capital stack should be structured. And I guess people like it. I mean, a lot of people reach out to me for help and understanding their capital stack. And you just try to be nice and provide as much value as you can all the time. And, LinkedIn has been a great source of just networking. And then once that happens and you get your foot in the door, I mean, once you're speaking to 30, 40 developers who know you and trust you and show you their deals and ask you to work with them, it's a lot of word of mouth referrals and things like that. You'll have, if you get good enough, I mean, if you get lucky enough and blessed enough, I guess, by God, is you'll have, once or twice a week, one of your clients will be like, hey, I know this guy, would you be interested in meeting him? And the networking, train just continues like that.
That's awesome. Well, Jonathan, that might be the title of our show. Special guest, Jonathan Livi, not a fluffy guy. That's that's what I think I'm going to make it.
I do it in my Bible classes too. I'm really simple. I'm like really focused on just trying to see what the text is trying to tell you.
Yep.
I just don't have patience for the fluff and the fanfare and the lovey-dovey stuff. I go on here, I post, I'll do some of that. I think anybody who's big on LinkedIn does some of that. Just like the non-real estate related point of interest that you just find funny and you want people to hear. But predominantly every post I share is either I did a campaign about sharing information without identities revealed, of course, but on interesting capital sources that people don't know about.
Yep.
So there are some interesting capital sources that fit between joint venture equity and preferred equity that are just it's like a funny structure. Joint venture equity partners that are looking for specific things. So I would post about their criteria and what they're looking for, and get loads of people just reaching out and saying, hey, this sounds like an interesting group. Maybe we could talk so I could learn more about them. And that would be like your window into speaking to them more generally about anything they're working on.
Yeah.
And then I do a lot of, I think I did I think one of my best series was one on understanding a joint venture equity term sheet. So I just took a term sheet that one of my clients provided to, a sponsor of mine, and I just blanked out everything that, had to relate to their identity or anything that would have unveiled who it was. And I just, taught people what each segment of that term sheet meant. So I think just cutting out the garbage and focusing on providing value and, useful information for people, it does go a long way.
No, that's awesome. And that's a perfect transition, because I saw that term sheet. It was 3 or 4 posts. And I definitely even learned some things, even though I've done joint venture equity deals. So now getting into some of the equity and the specifics of equity, right? I mean, just off the top of my head, I could think of joint venture equity, limited partner equity, CoGP equity. I mean, you can even get into preferred equity, which, looks more like debt than anything else. Run us through at least those first 3, and maybe that 4th one, preferred equity. Run us through what are all these different types of equity? What do they do? How are they different? So that everyone can understand. So I think there's a lot of confusion. I think a lot of people get into this space and it's just equity is equity, right? Sure. They put in money and I do deals, and that's that. Explain the differences.
Yeah, equity is definitely not equity. Different equity costs different amounts. There's cheaper equity, there's more expensive equity, and then there's also terms and conditions which come with all the equity. So there's more strict equity, more demanding equity, and less demanding equity. So I'll start with, we'll start from the top of the food chain, which is the most expensive, let's say, which would be CoGP equity. You use CoGP equity for one of two reasons. Either, any developer, as you know, whenever you have a joint venture partner who wants to come and sign on to a deal, they'll typically demand that the sponsor has skin in the game. So you're talking a 90-10 split of the equity portion of the deal. So say you have a deal at $40 million, 10 million of which is equity. 90-10 split would mean 90 million, 9 million would be brought by the joint venture partner, and $1 million would be brought by the sponsor. Now, say the sponsor is working at 5 deals at the same time. For one deal, putting $1 million together from, your closest with internal company money is pretty doable for developers of that scale. But if you're doing 5 deals, and you have $5 million that needs to be contributed for each deal, it becomes very difficult. So the first reason you use CoGP equity is to fill that portion of the stack, that small 10% of the contribution that the sponsor has to give as their skin in the game. There are companies that specialize in investing into that specific portion. They'll typically charge more for it. I'll see things between 20 and 30% of the fees that are being charged by the sponsor will be paid for someone who contributes that kind of capital, all on a pro rata basis, of course. So that's one reason you'd use a CoGP equity partner. Another reason you use CoGP equity is whenever you just don't, there's a part of the process, typically capital raising, they just don't want to handle. So you'll find a CoGP partner who will invest, not only will invest alongside you on on that 10% share that you need to give, but they'll also raise that 90% share that you need on the back end. So that's what a CoGP would do. And they'll also oftentimes, these groups come in all different colors, but sometimes they'll sign on debt for you. They'll provide credit enhancement if you want to get a big loan. They'll expose their balance sheet, of course, to get you the kind of debt that you need. Again, this is very expensive capital. They'll raise the LP equity for you, but then they'll also charge you an arm and a leg of your fees as a sponsor along the way. Groups like that, because they're the most expensive, they'll also be the most creative and the way they'll come into the deal. If let's say you want money for pre-development, which is a big headache that all developers have in almost every deal, there's a lot of money that needs to be spent before construction loan is taken out. Often closing on the land happens before that, and there's money that's spent throughout the whole entitlement process. So, and then that's also very risky money, because if your deal gets to the to the 10-yard line and then something goes wrong in the entitlement or zoning or something like that, then all that money you spent may end up being just wasted money on a deal that's not going to get off the ground. So if you want money for pre-dev, you're typically only looking at CoGP investments. Other sponsors potentially who will do a joint venture with you, but will take a nice portion of your fees. They may, they'll come along for the ride at that stage. So that's what we'll call like the top of the equity food chain.
One question I got on that, Jonathan.
Yeah.
Most of the people that you see as CoGP equity investors, are these mostly like individuals that you're seeing? Are they mostly institutions? Is it a mix? What is the makeup of your general CoGP equity investor?
It's all over the place. I have one family office that they're like a muscular family office where they have a lot of relationships and they could pretty much do deals on their own, but they just want to be capital guys because they don't want to, do like actual property management. So because they know so much, but they still just want to be in a capital position, they'll come in as CoGPs, on any deal. Other groups, there are individuals that do it. I know a few individuals that just have a couple. I know one in Frisco, and then one I think is in Washington D.C. But they just have very large balance sheets, and they know that they can provide the kind of credit enhancement that a lot of sponsors need. So they'll come in as a CoGP for the credit enhancement portion, and those are just individual guys. Those aren't people that are institutional anyway. And then you have there's one group out of New York. I'm not going to mention their name, but they built a whole business out of institutional CoGP investing, where they buy into a programmatic venture with the joint venture partner, and along the whole way they're staying as CoGPs the whole time. So you'll see there's a unique landscape of these groups, and then often, to be honest, sometimes it takes a level of creativity of, I have a sponsor here with a phenomenal deal, and I know he needs a CoGP partner, And I don't really know if there are any institutions that want to do this deal, but I know that his competitor down the block, if I structure the CoGP venture for them to work on, they may be able to work on this together and just share their, share of the fees and things like that and get the deal done together. So sometimes you'll just create a CoGP joint venture with two developers that are pretty much playing in the same sandbox, Typically, there you'll definitely get into some gray area, and you'll probably have some egos butting heads at some point. But
developers with egos, no.
Right. So, but that's another way you could structure it.
That's awesome. No, that's great. Well, bring us to the next rung.
So the next one would be joint venture equity, which would be a single check equity writer that's taking a common equity portion in your deal. But these are institutional groups, and they're doing it as a joint venture between their group. They're taking an LP position or a common equity position, but they'll write a large check. I mean, these are institutional groups where we really rely on as like the backbone of our business, where they're writing checks that start at typically $5 million, and they'll go as large as $30, $40, $50 million for any given deal. So these groups, typical terms are 90-10 or 80-20 joint venture, split of equity contributed, which means that 90% will be provided by them, 10% must be contributed by the sponsor, which I already alluded to. But then these groups, because they're large and because they'll write a large check and get the deal done for you, they're typically a little bit more expensive. In their term sheets, they'll dictate the fees that you're allowed to take as a sponsor, and they come with major decision rights. So the typical decision rights that they require, that they get to vote on, are refinance, major capex expenses, and sale, which are the three big ones. So all the big ticket items, they'll need to be, they're the group that'll decide, because they'll have all the voting share. So that's like a joint venture LP equity. In terms of what the typical waterfall is, they're typically structuring things with like an 8 to 10 preferred return, 8 to 10% preferred return, which just means that portion of the waterfall which is unpromoted by the sponsor. And then after that, the waterfalls are pretty standard. If it's a complex waterfall, they'll have like 3 tiers, and they'll go to like they'll give you a small portion until a 12, and then another portion till a 15, and then a very generous split thereafter. But it's all, there's a market for these things, and depending on the quality of the sponsor and the quality of the deal and the market that it's in, you'll have different waterfalls, but they all look pretty much the same, starting with that 8 to 10 pref or something.
Yeah, no, and I think maybe if we have time after this, let's dig into just a typical waterfall structure.
Sure.
Okay, well that's joint venture. Any other types of equity that
I mean, LP equity, which is not structured as a joint venture, would be small check writers, retail investors like mom and pop, 250 grand checks, 100 grand checks, that are that's what the syndicators are looking for. A real headache to get those things cobbled together, but if you do, the sponsor makes all the decisions, because there's no individual investor which with enough invested to make any decisions. And that's where you'll see the sponsors making real money on fees. I mean, they're not going to get away with charging a 3% acquisition fee from an institution on a $30 million deal. But I saw a deal that was $50 million, and it was being syndicated. So the syndicates, the mini check writers that are writing $100,000 checks, they may all be in different industries, so they don't know what the market rate fee. So the fee that the sponsor started with for the acquisition was 5%.
Oh my goodness!
$2.5 million on a $50 million deal, and it was built. Obviously, it was a closing cost. It would be it would be raised as part of the syndication. So I'm not complaining. I mean, I don't mind.
Oh yeah, good
money. And if they're delivering, look, one rule I do have is, if they're delivering the returns to their investors, I don't mind paying fees. You know what I mean?
Yep.
If I'm looking for an 18% IRR or a 9% cash on cash, and you're getting it to me, and you're good at it, and you're doing it successfully, and you demand a 5% acquisition fee for me to get into your deal, but if I determine that it's worth it, I'll pay it. You know what I mean? I'm not saying that the developer did anything wrong. I'm just pointing out that those kinds of fees They wouldn't fly with a joint
Yeah.
venture partner of an institutional scale, you know.
You have more leverage, right? I mean, you're hitting
You have
a
more
certain
leverage. There's more
benchmark.
asymmetry of information. So
Exactly.
there's more wiggle room. Developer, the real difficulty comes at the beginning when they're raising the money, and as they have to answer questions from 40 people that are in the syndication or prepare K1s for all those people. But the benefit they get is that these people do make a lot of money on fees if they're, you know, structuring their deals right, or if they're taking advantage of it, and they make all the decisions. So they choose when to sell, they choose when to refinance, and they choose if they want to do a capital call or make a large capex contribution of some sort.
Yeah, no,
So that would be, you know, simple LP equity. If you're trying to learn about what we do, that's not what we do. I mean, we do it under CoGP investments, but we're going to be the syndicates in that, the syndicators in that, you know, position. You know what I mean?
Yep. No, that's and then just so everybody can clear the air, right? I mean, you have this other class, it's called preferred equity. I don't know how much of it you do or don't do. A lot
we just closed the preferred equity on Friday, so
perfect.
I could walk you through it very clearly.
Yeah. Why don't you walk everyone through that? Because I've seen a lot. I mean, it's fairly new to the capital markets, relatively, compared to some of these other types of equity, and it's not widely known necessarily by a lot of people because it kind of sits in this weird in between debt, equity. People are looking at it from different perspectives. Go ahead and tell us about preferred equity.
Right. Preferred equity, first and foremost, to clear the air, it's a debt product. It's a debt instrument.
Exactly.
If you're trying to do a low risk deal in which you're downside protected, preferred equity is not just any equity. So you are not protecting your downside if you're putting preferred equity into your deal. Now, I make a lot of money on preferred equity transactions. I mean, those are the easiest ones to get done. It's like, you know, as a mortgage broker, there are deals where the operator comes to you and just asks for like the easiest mortgage possible. And there are some when they ask for a very difficult transaction where their expectations are high and the deal is hard. In the equity world, in the equity brokerage world, the low-hanging fruit of the easier executions are those preferred equity, you know, transactions. So like, it'll very often happen, I'm not going to lie about this, where somebody comes to us with the joint venture request and we say, look, we're not going to find the family office for this deal or a private equity fund for this deal. If you'd like us to structure a preferred equity investment and show you how it looks, we're happy to do so. I know it's not what you asked for, but it's something we do very often because it's easier to structure. And why it's so easy to structure is because it's not really equity, it's debt. And the way it works is, let's say I'm a developer or an owner operator and I'm buying a multifamily deal and I'm paying $50 million for the deal, and my senior lender offers me $35 million. Now I have to raise $15 million of capital. So if I'm a syndicator, that's a lot of small checks to collect. So what I may do is I may stick a preferred equity piece into that capital stack. So the senior debt would go to, let's say, 75%. And then I'll take a preferred equity investor and they'll sit behind the senior debt and they'll take you from 75 to 85% of the stack. So they'll cover 10% of the stack. So they'll write like a $5 million check, we'll say. So your entire capital stack that you have to raise for just went from 15 to 10 million, which helps a lot. On the flip side, what they ask for is a current pay and an all-in look-back IRR. So what that means is they'll tell you, look, our money, our preferred equity, we're going to get paid first. We're going to get paid before your investors. And when you sell the asset, we're getting all of our money out, plus our expected return before any of your investors get their money out. So that's where they're protected. That's why it's preferred equity, because they're preferred in the capital stack and they're subordinating the common equity behind them. Now, what they do in exchange for that is that they'll always charge a lower IRR than your common equity is getting. So if the deal is sporting a levered 16% IRR, these groups traditionally will come in between 12 and 14% all-in IRR on the deal, is what they're looking for to achieve. And the reason they're settling for that is because they're lower in the stack. Now, the reason it's risky is, it's risky for your common equity investors because they'll typically have an all-in return that they expect, which I said is about 12%, but then they'll always ask for a portion of it to be paid current, which means we need 6 to 9% of that 12% IRR. We need it to be paid out of cash flow. And if you don't hit those cash flows, we get to sweep your capital. And if even after sweeping all the capital, we're not hitting our, we'll call it the hard pay rate of, let's say it could be 4%, then you're technically in default. So then the preferred equity investor will be able to take over the operating agreements and just start operating the property themselves. Now, God forbid that happens, obviously, nobody wants that to happen, but that's the risk you have, because you already had that risk with your senior lender. And then if you insert a preferred equity investor in there, not only do you have to worry about paying your senior lender, you also now have to make sure you're paying your preferred equity, and both of them come with default risk.
Yep.
So that's what preferred equity is. Again, the way it will typically be structured is, let's say a deal right now, multifamily deals, existing deals, preferred equity costs between 11% and 14% on an IRR basis. And the current pay rates are typically between 6 and 9% on these deals. So you'll pay them their, let's say, 9% current pay. And then when you sell the asset and everybody's collecting their profits, they'll get their money out. Then they'll get their total IRR of 13%, which had been accruing, all this time. And then once they get paid all of their capital back with their IRR of 13%, and they've collected their current pay, coupons throughout the life of the investment, then they're finally out of the deal, and your common equity investors could now take their portion. Now, what typically happens is that though it's more risky, it's beneficial for two reasons. One is it makes the capital raise a lot smaller. And two is that it juices returns for the common equity investors. Because if my deal was a 17% IRR for the common equity, and then I inserted a 12% look back IRR for preferred equity portion, at 17%, which was the deal prior, now may turn into like a 22% IRR for my investor.
Exactly.
Just because other capital in the stack has now become cheaper. So you do enhance your risk, but you're juicing returns. So it's it's up to you to decide if it's the kind of risk you're willing to take. Then there are even other structures which we do. So there's a soft pref equity, which comes with none of the risks of going into default throughout the life of the property, but it does come, they still require being paid back on the capital event first. So come with exit risk, but no operating risk or whatever you want to call it. And then you have mezz debt, which you'll sometimes place into deals that are very low levered. Like the perfect mezz debt scenario would be some guy sitting on a property, it's 300 units with a 50% leverage agency debt on his property. And he wants to pull out some equity on his deal because, the property values went up like crazy.
Mm-hmm.
He originally had an agency debt at 75%, and now it's worth 50% of what the property is actually worth. So there are a lot of mezz lenders which will take the part of the stack from like 50% to like 65 or 70%, which is a very protected position for them. But they'll cost between all in like 8 and 9%, and they'll charge very low current pay rates. So that's another part of the form of capital, which is also very similar to preferred equity.
Yep.
But we just use it in more, very downside protected situations.
Yeah, no, that's I've seen that a lot. I mean, even with the preferred equity and the mezz debt, I've seen a lot of lenders, a lot of groups will play in both of those sandboxes.
Mm-hmm.
I mean, I've had a deal recently where we wanted preferred equity, but we had TIC owners. And for anybody listening, preferred equity and TIC owners don't mesh, right? That it doesn't work because a
lot of financing is very hard with TIC owners, to be honest.
Yeah. Well,
and putting a TIC into your deal is like, you have to be ready for struggles with financing. There are a lot of, more structured finance groups that just aren't. For anybody wondering what a TIC is, it's whenever a big group of investors, they all own direct, they all have direct ownership to the property instead of investing into an entity which is owning the property. It has 1031 benefits, so that each individual investor has the ability to 1031 out of the property and their own, with their own entity. So that's why a lot of people do it. A lot of bigger investors that are, writing large checks will demand that they come in as a TIC partner instead of a traditional, buying into the entity.
Exactly. And so, we do that and facilitate our investors, in that a decent amount of the time. But yeah, I had one lender that we wanted the preferred equity, but obviously they don't mix because the preferred equity wants to take that priority position to a TIC owner. And you can't do that. If they came from a 1031 exchange into the TIC, The problem is that relationship then ruins their 1031 exchange status. And so you can't do the preferred equity with the tick. So we basically had a preferred equity lender that says, okay, here's what we'll do. I'm going to bring in preferred equity. It's going to look like preferred equity. It's going to smell like preferred equity. It's going to act like preferred equity, but we're going to call it mezz debt. And, and so there's a lot of creativity that can happen, especially in these equity transactions. Jonathan, one thing I want to get to, because I know a lot of our listeners have often asked this question, waterfalls. I mean, the second you start talking about waterfalls to anybody who's not in finance, it's like the eyes just start glazing over and they're like, I have no idea what you're even talking about. Like, I just want so how much money am I getting? Kind of question. Can you break down just what a waterfall is and then maybe what a typical waterfall would look like?
Sure. So on the topic of how to understand a waterfall, I'm not going to go into explaining from day 1 to year 5 how it all breaks down, because I'll tell you how I learned and how I understood it is I actually took a course from Justin Kivel on Udemy just to see. I didn't need to learn how to model it because it's not really what I do all day. I just wanted to see from in Excel where all the money is going in the waterfall. So if you really want to understand how the money is distributed in the waterfall, I would recommend learning how to model it. Because it's the only way you'll see where every dollar is going.
Yep.
I could tell it to you, more broadly. You're not going to get a real nuanced understanding of it, but more broadly, the waterfall is just an agreement between the two partners in the deal, the common equity partner and the operator, who's called the sponsor, on how they're going to distribute cash flows. So the sponsor will typically come with, an acquisition fee, maybe an asset management fee, which is always a matter of contention. If it's a development deal, will come with a construction management fee. But then the bulk of the money that the sponsor is making is that they're going to get an outsized portion of cash flows from the deal due to their performance or based on their performance. So what a waterfall does is that it just creates a situation or creates a scenario for the sponsor and says, look, sponsor, it's not that hard to give me, the common equity investor, an 8% return. So you're not going to get any fees or any promoted interest, we'll call it, until I hit my 8% return. So I need to get my capital back and I need to get 8% on my money. After that, we can start to discuss what your fees or what your promote is going to be like, or your promoted interest, your extra, the extra money that you're taking from cash flow. And if, up until that 8% preferred return that I'm getting, I contributed 90% of the money and you contributed 10%, we're just going to split it 90-10 because I'm not letting you keep any of it. But if you, Mr. Sponsor, get past that 8% preferred return and show me a 12% IRR, then any of the money that got me from my 8 to my 12, instead of letting you only keep 10% of the cash flows, I'm going to let you keep 20% of the cash flows. So even though the sponsor only contributed 10% of the money, there is, upon exiting the property, there's a portion of the cash flows which are going to split unevenly, where the sponsor will be taking 20% instead of the 10% that's his pro rata share. So that's as simply as I can explain what a waterfall is. And you can imagine it just goes, and the further up the IRR scale it goes, the more the sponsor is going to collect out of the waterfall. So there are groups that they're only really looking to hit a 15% IRR. I know one LP equity group that's very focused on hitting their 15% IRR. So once they get to 15%, they'll allow the sponsor to take 50% of cash flows and only keep 50 for themselves, And then you'll see deals which are like, I'll tell you, the build-to-suit retail market, which is a very, very, very commoditized equity market. Equity splits are completely different. And in those markets, you'll see equity splits as aggressive as the sponsor collects 70% after hitting an 8% preferred return, and the investor only gets 30%, even though they contributed 90% of the equity. So depending on the asset class that you're in, or the structure of the development, or the strength of the operator, or the quality of the deal, you'll distribute the cash flows from the waterfall differently. But the basic principle is that it's just an agreement on how to pay the sponsor more for achieving certain results. in IRR terms. And why the common equity wants to pay it is because you always want a motivated sponsor. If the sponsor is going to make the same amount, whether they hit a 15% IRR or 22% IRR, then they may have other deals to work on, so they'll just go and focus on other deals. But if they know that they're going to really have a huge windfall if they break that 20% IRR threshold, then they're going to work their butt off until they get there. So you incentivize the sponsors for doing that. Again, the typical waterfalls, I'm not going to explain what this all means, but it's typically starting at an 8 to 10 pref due to the common equity investor. And then the waterfall, if it's a 90-10 split, will typically become like an 80-20 after that until a 15, and then it can convert to like a 70-30. Or, it could be any, at that point, it's just a negotiation on how you want your waterfall to look. But that would be like
awesome.
More market rate stuff.
That was a great explanation. Thank you for doing that, Jonathan. And one of the things to kind of take away, right, as we're talking about all of this for everybody who's listening, the reason this can be somewhat confusing is because there is like an infinite number of options to put this all together. I mean, you can get as creative or as not creative as you want. I mean, it can be as simple as like, hey, it's just like a down payment on a house. One group brings in equity capital, one group brings in debt, and we do the deal. And that's it, and we're done, and we move on, right? But you can get multiple layers, multiple levels. You can combine different things. And so there is a lot of creativity that can go into this, all based on, hey, what's the optimal structure, right? What at the end of the day is going to make everybody the most money. You can bring in all sorts of different pieces in order to do that. And so Jonathan's just really touched the surface here on a broad spectrum. But you could dig in and you could find, different subsets and all of the things that he's talking about where people do a little bit different activities, right? I mean, in the JV, it could be a little bit different. In the LP equity, things can look a little bit different. It's not all set and structured like you might see in a lot of
it's definitely not very commoditized at all in the equity market. Everything is different. And, as an equity broker, you're constantly looking for new groups that are interested in deploying capital. And if you find a group that has cheaper capital than your competitor, that competitor may be doing 10 times more volume than you, but you have an edge because you found there's not a commoditized business. And if your capital is cheaper than the next guy, or if you have a group that's willing to deploy capital more readily than the next guy, then you always have an edge. One of my favorite things about the business is that there is so much structuring involved that the broker can become very, very useful. I mean, like a lot of times sponsors don't even know how to negotiate these things because they don't even have a real intuitive understanding of it. So you can provide a lot of value to your sponsor if you really know what you're doing.
That's awesome. Well, Jonathan, we're going to wrap up here a little bit. I'm going to ask just a couple of questions that I ask all my guests. Number one, what is the best business advice you were ever given?
Appreciate failure a lot. Just live in the failure. Let it wash over you and just feel it helping you grow. I think learning to live with failure and learning to have that growth mindset from failure, I think is the greatest thing you're going to do for yourself. Because there's something I have on my wall. It says, when nothing seems to help, I go and I look at a stonecutter hammering away at his rock, perhaps 100 times without as much as a crack showing in it. It has 101st blow. At the 101st blow, it'll split in two. And I know it was not that last blow that did it, but all that had gone before. So all those failures before are helping you build to like a certain level of success. And when the success comes, it'll come. But if you don't have the ability to, the thick skin to withstand a certain amount of failure before you get there, it's not going to come together.
I completely agree. I mean, I think that's honestly, if you are a business executive, a business owner, a real estate investor, whatever you are, I think learning to not only just make it through those failures, but thrive off of a failure is what separates people from being, okay and being great. I honestly, I've often been told, in my own circumstance, I've often been told as a real estate developer, oh, I'm really risky. And it's like, all these things. It's like, I feel like I'm learning, I'm constantly learning to thrive off of failure, right? I learn more, I grow more from the failures than I do from the successes, and I want those successes. I need those successes, but the failures are really where I go from, here to here in my growth. Successes, everybody gets to do a high five and celebrate, but I don't necessarily grow nearly as much as I do from learning off of a failure.
Mm-hmm. Yeah, exactly.
Awesome. Great advice. If everyone should just go back and listen to that again, that like last 2-minute segment, because if you got nothing else from this podcast, from this episode, then that you would be infinitely better off than you are right now. Next question, Jonathan, what real estate investing advice would you give other business owners or business executives?
I'm scared to say this because I make money off people levering up their deals, but especially where we are in the cycle, just don't over lever. There's a big temptation right now. I know you asked more broadly in business, but I'm stuck in the real estate world. So
you're good.
But don't over lever, because right now yields are so low that there's going to be a temptation to use more leverage just to hit the yield you were getting 5 years ago. And it's a never ending cycle. You may end up just shooting yourself in the foot and losing it all. So not using too much leverage, staying with non-recourse debt and not using too much leverage, I think is very, very, very key, especially for where we are in the cycle. Now, if we're at the bottom of a cycle and things are dirt cheap and, and you're pretty confident you're at the bottom, then use all the leverage you want. If you can find it, you can find people willing to lend it to you.
Yeah, that's the trick.
But right now, when everybody's flush with capital and prices are extremely high, be okay making less.
So follow-up
you don't
question.
You don't need to make 40% IRR on every deal, because if you try to shoot for that, you're probably doing it with a financial tool and not due to real fundamentals.
I love it. Well, Jonathan, I got a follow-up question for you then on that one. What do you feel right now? Where do you feel like that leverage should lie in general? Obviously, it's going to be different for different asset classes. But if you were to just, pick a number out of an air and say, generally, this is what I would say, what's that number for you?
Long-term fixed rate debt at 70%. If you're talking multifamily acquisition, 70, none of your deals are going to work. You won't be able to underwrite anything. So maybe you'll just be on the sidelines, or maybe you should find another asset class. But let's say you're talking multifamily acquisitions.
Mm-hmm.
I'm nobody to speak. Like it's not like I'm operating 4,000 units. Other guys have done it more successfully than I have. But just I invested in a couple of deals in New York, and I saw, especially when the market started getting more overregulated, and the underlying value of our properties went down overnight due to some regulation which was outside of our what we ever imagined would happen. So what's becoming the biggest problem on those deals is that you have debt maturities coming up, and like if you can't get out of those debt maturities, you're going to lose everything.
Yep.
So that would be my basic advice.
Love it. I think that's great advice. I mean, all the time, in the development world, you see new developers who struggle to get capital, and so they try and counteract that by going. I mean, I've seen 90, and I'm 100%
like a
leverage.
Major hypocrite right now, because when I'm in brokerage mode, and I know I can get a deal done, if the sponsor is willing to take the high leverage, I'm not rich enough to just tell them like, no, I'm sorry, like I'm not gonna do this deal with you. I'm not gonna introduce you to that high leverage group that's gonna do your deal tomorrow. I'll make that introduction, but but that's the guy's own decision. Like,
Yep, agreed.
I don't know to what extent as a broker I need to save people from themselves.
No, and
a lot of times, if you're doing, existing multifamily, and like, do I think it's a preferred equity investment is going to definitely kill you? No, of course not. Like, multifamily is a pretty stable asset class overall. But I'm just, but for my personal money, that the commissions that I make and where I invest them, I only invest in very low leverage deals.
Love it. Well, hey, I appreciate it, Jonathan. How can people get in touch with you?
Email is jlevy@buckinghamadvisors.com. Easiest way to reach me. You could also DM me on LinkedIn. I'm not a big fan of people calling me out of the blue and then leaving a voicemail because I tend to miss voicemails. But if somebody wants to call me and then email me saying that they called so that I could just quickly see what the call is going to be about and get back, it would be, that's pretty much the easiest way. I like to have everything in writing because I have short-term memory. And if somebody just calls me and expects me to remember that I called them, it's much easier for me to remember if I have, their email sitting in my inbox. So
love it.
That'd probably be the best way. jlevy@buckinghamadvisors.com.
Well, we'll go ahead. We'll make sure that his email and his LinkedIn contact is in the show notes so everyone can see that there. Jonathan, thank you for your time today.
My pleasure. Thank you so much, Michael.
Thank you for listening to the Executive Real Estate Investing Show. Ready to learn more? Go to executivereishow.com for more episodes and resources to help you create generational wealth through real estate investing. That's executivereishow.com.